Under the OECD guidelines, there are 5 methods that can be used to help determine if the relations are at an arm's length. The first 3 are traditional transaction methods, whereas the last 2 are transactional profit methods. When one of the traditional transaction methods cannot be used, one of the 2 transactional profit methods should be used. In this clip, we explore the 2 transactional profit methods. The first is the profit split method, or PSM. This method potentially applies where associated entities in a cross-border transaction have something unique to offer to a transaction. And there is also an economically valid basis for splitting the profits between the entities. The aim is to approximate the way that profits would have been split between independent parties acting at arm's length. For example, Aircon Proprietary Limited is an Australian company that develops technology that will assist in the building of air conditioners that are more efficient than others currently in the market. It provides its technology, which is subject to intellectual property laws, to its German parent company. The German company, using the supplied technology, as well as its own technology and precision machinery, manufactures highly efficient air conditioners. If, under this arrangement, an economically valid basis could be found for allocating the profit between Aircon and its parent, the PSM could be used. The transactional net margin method is the second approach. This uses the net margin of a comparable independent cross-border transaction. It then applies this net margin to the taxpayer's cross-border transaction with a related party. The comparable transaction can either be one that the taxpayer has with an independent cross-border entity or one that the third party has with an independent cross-border entity. Note that when using this method, a choice needs to be made about what to apply the net margin against as an appropriate base. This requires the calculation of an appropriate ratio. For example, the taxpayer might use the net margin to assets, to costs, to sales, or to shareholders' funds as an appropriate base. Further, when utilising the net margin figure, a decision should be made regarding whether it should exclude some costs from the net margin, such as tax and interest, in order to improve its comparability. For example, an Australian company, Comfort Limited, has found a way of processing wool that makes it feel softer than most existing woolen garments. The company makes woolen garments and sells them to its Korean associate. Comfort cannot obtain data that would make it able to accurately calculate the comparable, uncontrolled price on equivalent garments. However, it is able to obtain information on the net profit to sales ratio of an Australian competitor. This competitor sells similar garments to an independent Korean entity. Comfort could use this ratio to determine the comparable arm's length price it sells the garments to a related Korean entity. Comfort, in doing so, might need to take into account any differences between its competitors and itself, such as different business strategies and funding arrangements. To recap, there are 5 methods that can potentially be used to determine the arm's length price of a cross-border related party transaction. Which technique to use in any situation depends on the nature of a taxpayer's transaction, as well as what information it has access to. If there is sufficient information to use one of the traditional transaction methods, then one of those methods should be used. The transactional profit methods should be used where profits between related parties can be split on a valid basis or a net margin profit ratio can be applied from a comparable transaction.